All right, well, welcome everybody to a special evening presentation of what is normally a program that we do at 2 o'clock on Tuesday afternoons, but I was diverted by some other appointments today, and I am grateful that those of you that are here with us tonight at 8 o'clock, again, a special time. We may tinker with this type of stuff from time to time, but Tuesdays at 2 o'clock, for those of you that cannot make them during the day, we do archive all of the presentations on YouTube. If you're not aware of that, we'll cover that also today. And yes, that would be Ken and I back in the pool again. Fortunately, we're not swimming in the river, Ken, and we are allowed to swim in the pool in Paris. So good times by all. So how are you doing tonight, sir?
I'm doing just fine. You must spend hours putting these opening slides together, Mark. I'll tell you.
Well, there's no Photoshop is involved here.
I know none at all. No. Okay.
And we're also joined here by special guests. First of all, from Florida/Indiana, Kim Butcher. Good evening,
Hello,
Kim.
everybody. Good evening.
It sounds like you were weathering the market storm very nicely.
Until I sent you an email and I got a response, I didn't know anything about it. I'm, cleaning out closets, doing laundry. That's a bigger priority.
Life getting in the way. Now, are you in Indiana or Florida?
Well, I'm in Indiana. I have to wait until this Debbie and all the rain gets through those states, and then I have to find out which highways may have issues because I don't want to drive back down there and end up can't get.
Laura Scott, I don't think she's in the audience, but she's a volunteer for Better Investing. She sent pictures of roads being wiped out by the floodwaters down there. So
yeah,
okay. Nasty stuff.
Yeah, I'm kind of have to ask you later as to which roads.
All right, and last but not least, Matt Spielman is joining us here tonight. Good evening, Matt.
Good evening. Good evening, everybody.
And Matt's going to touch on keeping score and a couple of our favorite things to do and check in on. So let's go ahead and get underway with the speed of an Olympic gymnast and the floor exercise or whatever. But we are going to talk about the disruption in the market right now. It's been a few moments of Jim Cramer and a few other topics. Let's go ahead and get underway. Anything else, Ken?
No, I like what you have on the agenda for this evening, Mark. Oh, here's those hot dogs. Oh, this is meatballs.
Hey,
no, maybe it's beef, huh?
We're going with the beef sandwich, and yeah, we are awarding medals just to taunt Kevin. Kevin likes to talk about every hot dog known to man and every hot dog stand in the Western Hemisphere. But Portillo's did come down to a price of $8.88. I believe it touched $10 at one point this afternoon. So a pretty good recovery from the swoon. This is our weekly reminder that Portillo's is not a sponsor of this session, but they should be. All right. Quick disclaimer, no investment recommendation is intended. This is all about the education, illustration, and demonstration of the principles, methods, and techniques of the modern investment club movement. Specifically, it comes down to the discovery of investment opportunities, the analysis of said opportunities, and the construction and design of a portfolio with core stocks, and we'll talk a little bit about non-core stocks, but the maintenance and monitoring of those portfolios. Please do your homework before making any decision. If we own something that we are talking about, we'll try to remember to disclose that, and we assume that you are smart enough to form your own opinions about investing related resources. If you would like copies of these slides, or if you have questions about these bull sessions or suggestions for future topics, our two email addresses are there at the bottom of the page. Anything else, Ken? We have a second boilerplate tonight also.
I think we're doing fine.
I did want to put this one in here. This just kind of gives you some of the genesis. I don't know if you knew this, Ken, but we've already been doing this like 4 years. On Tuesday afternoon.
It's been a lot longer than either of us anticipated, Mark. So I'm very pleased.
I will tell you that we have touched on some areas that I never would have dreamt. You can read on that right sidebar some of the stuff that we've kicked around. We are going to talk about Cramer's COVID-19 index tonight. I found that interesting that was in there. And what I also found interesting that Life After Google, the book by George Gilder, is not listed on that particular list, but we've had some fun with some pretty cool topics along the way. So
I think you lifted this, Mark, out of a much earlier session, because the second paragraph says we've been doing these approximately 1 year, and I know it's
right.
been a lot longer than 1 year. So
And that
yeah.
was the first year. So again, I was kind of taken back by the breadth of some of the topics as I look back over the for some highlights a week or so ago. And so I'm probably going to do something along those lines. But it isn't meant to be informal. If you have audio equipment, raise your hand or send us a text in the box, and we'll try not to let it go too long. This one might run a little bit more than an hour, simply because we're going to have too much fun. But that's typically what we do. And again, nothing's off limits as far as exploring the realm of investing. Here is kind of a special disclaimer screen because as we even in the warm up tonight, we were talking about me buying a stock and selling it. It was actually an ETF yesterday morning. I don't do that very often, but every once in a while, it's just too tempting, and I like to pretend to be a gambler. I'm actually very far from being a gambler of any sort, but every once in a while I will do that. So this is just to make a few things clear. We believe in core investing, but we also believe that there can be non-core special situations. They can be fun. They can also be expensive, complete with the lesions and abrasions mentioned there in the second bullet. I had an option expire worthless for the first time in my life not too long ago. I don't like it when that happens. We do occasionally discuss non-core special situations here. They are truly speculation. Every once in a while, you might hear us talk about a legend, like the one where I bought Western Alliance in the morning and sold it by lunchtime. And that was an interesting day for Western Alliance. That is an excerpt from my tax return, just to show you that we do tell the truth here, and that is exactly what happened. So when I say that I gained 158% stock percent on a stock that declined 84.9% one day, it's the truth, and the numbers are all right there. And so again, very rare. I subsequently purchased a position in Western Alliance, and yes, Kevin, I still hold it, because Kevin's worried about me. But that one is now a long-term capital gain.
Well, the other side of the Western Alliance coin, Mark, is that I had always owned Western Alliance over the last 4 or 5 years. And when it went down, I started buying some of it in the teens and continued to buy it through the 40s. And it's now trading above 70. So it's also the kind of stock that I would like to see stay in my portfolio for as long as it makes sense.
Yeah, and in fact, I'm going to tell a tale out of school. We do talk every once in a while about our transactions in the Manifest Forum. And Kevin, you should know that Matt actually trimmed a couple shares of Western Alliance because it has done so well for him that it was dominating his percent of total assets. So
Yeah, I've trimmed 25%, probably a little north of that. But you can guess what my number 1 and number 2 positions in my portfolio are. It wouldn't be a hard guess. It would still grow. When you're pruning, it still keeps growing.
Yep, that one has been good too. So again, this is just full disclosure. We do every once in a while talk about weird stuff, but Ken and I were actually talking about how I have stuff in my portfolio I've almost forgotten about. Like I had forgotten. I've had CBS so long, Ken, that I have a positive net gain in the stock.
Well, Natalie does in her IRA also, Mark. So
good stuff. All right, so let's talk about what's going on in the world of investing. And we are basically going to spend just a few minutes talking about what you need to be doing every time you see this. Now, Ken, I know you've been hiding from your phone and the TV. This is what's been happening without you. I don't know how CNBC exists without you when you're not tuning in, but every time you see this on the screen, there's a few things you should be thinking. And we'll start with this one. And the one on the left was sent to me by Sean about 4 o'clock in the morning. And it was after that first really bad day of the nasty stuff that had been going on in Japan. And he goes all the way back to this on this Twitter post and or tweet, and going back to Chevy Chase pointing out that tomorrow's already happening in Japan. And it was already recovering. That's part of the reason that I bought the QQQ ETF this morning. Just maybe to take advantage on this if that same impact was felt over here. And Kim is with us. That graph on the right is what she sent me, just to remind that every time that this CNBC graphic shows up, you should flip mentally to the picture on the right.
I thought especially that graph is real good because if it goes down 10%, your return 1 year later is higher. So the market goes up, the market goes down. Don't stress.
It's on sale. When the grocery store goes down 10%, people would cheer and all run there.
Yep.
But when the market does it, people run away.
No, we just have to get people to recognize we women like to shop, and we only like to shop when we can find a bargain.
Yeah,
stocks are closed.
This really is an amazing graphic when you think about it. These are days when the market was melting down and the news anchors had your 401k in their armpit, and they were talking about how your 401k was tanking. And every one of these days, and you look at 1 year from that date, they have that's a 100% or a batting average of 1,000. I'm telling you, when you see this, go shopping. Find an excellent company that you've been thinking about buying for a while and buy it. If the price,
especially as you say, Mark, and you've done the statistics to show that when you can find a great stock who is a core stock and the RSI is under 30 is good, but under 20 is better. And I have to admit that I found one that was at, I think it was 14, and I was like, oh, yes.
Yeah, I had a couple people send me notes on Gentex. Matt recently presented Gentex, and a few people said Gentex was down in that zone of being oversold.
I actually bought some on Friday. I didn't get to buy some Monday because, of course, all the brokers were down. I was running errands, and I considered stopping by the Schwab office maybe just to see how they were really running, but I just got some, so we're okay.
You have an office you can get into? I'm shocked.
Oh yeah, right next to the Fidelity office. You keep them both on their toes.
Mark, I see that the Motley Fool refers to a 10% decline in 2023. Do we know what month that occurred in?
I don't know off the top of my head. Anybody out there? Is Len with us tonight? He can certainly tell us.
Because I'm just thinking to myself that it's been more than a year since we experienced one of these downturns, and we're usually supposed to see at least one, maybe two a year. So I just can't get really excited about this downturn and I guess it did hit 10% at one point in some of the indexes, but I just can't get that excited about the whole thing.
I see a sharp downturn last October. That's at a weekly level, though, so it may not be there. It looks like October 23rd last year.
Yeah, that's what Sandy and Phil are both telling us, too. Probably October 23. So 8, 9, 10, 11 months. That's not that bad, I guess. Okay.
I like these bullets just because the Motley Fool has a very similar perspective on many things. And we love Morgan Housel. And he just says, this is, our attitude as a community is so different. It's just magnificently different. And we recognize that the volatility and uncertainty are going to basically churn things up and create some opportunities. And there are very few people out there in the world of investing, especially on the trading side, that feel that same way. So pretty cool. Anything else you'd like to add here, Ken? I know you were talking about.
I like Housel's comparing it to the psychological price of admission.
Yep.
It's like buying a season ticket to the theater. I enjoy the theater immensely, and we go a dozen different times with one of our subscriptions. But that one time a year when you have to actually buy the tickets, that hits you a little bit harder than you might expect sometimes. So it's just what you have to do to get the pleasure. That's all.
Yeah, if you want to be a successful long-term investor, you just have to learn how to deal with that challenging psychology. And this one checks in with Sean Mace. I like the graphic on the left, especially for young people to have, and Sean's pretty young, to have this type of an attitude. And for young investors to know that a market meltdown is really an opportunity. It's pretty cool. Plus, he featured the groundhog. And he's from Pennsylvania, so he can do that legally. Ken, we still have our trip to Punxsutawney on the planning board.
A non-closed polygon. Okay, that's a unique kind of a thing there. Okay.
Poor Julia gone. All right, so let's talk Groundhog Challenge. It has not been kind. The big number there, we went from nearly an 8% average return down to 1. We have recovered back to about 3, maybe 3.5 in the day that followed, which was today. But the carnage has been pretty massive. I did find it interesting that Jim Gallagher at the number 1 position accounted for 60 or 70% of the gains by all 180 of us. So
he's our magnificent one.
He is a magnificent one.
There's the home run. You don't need many of them, right, Mark?
He's doing well. I don't think we've ever had a lead quite that large at this point. We are at the halfway point between Groundhog Day to Groundhog Day, and pretty fascinating.
He's the Katie Ledecky of groundhogs, Mark. Okay.
There you go.
All right. I'm keeping track of how many clubs are in the top 40, and we hit a new record again today. I think if you count, folks, you'll find 14 clubs in the top 40 right now, and that's the highest that we've been since the contest started this year.
Is each asterisk, Mark, is that how many times, like the broad assets of St. Louis have won 3 times? Is that what the 3 asterisks are?
Yes, those are championships. So group championships 3 times by broad assets from St. Louis, and number 12 is the Bauer City Ladies with Susan Michalik out of Janesville, Wisconsin. So those are 3-time winners.
Yeah, Mark also tells me that there's 7 clubs in the next 10 spots. So 41 through 50 have 7 clubs. So maybe we can break that 14 in the next coming weeks here. We'll see.
Could be. All right, since I'm down at, by the way, I cracked into the top 40 for a few minutes, and I believe I'm now like 153rd. So it just shows you what leverage can do to you. That yen theory trade. All right, so let's talk a little bit about what is going on in the market. Matt was referring to this VIX in the pre-session, our green room, but this is what's been going on. The market has become much less stable. You might even call it unstable here over the last few weeks. And the jobs report bothered it. The failure to make a cut bothered it a little bit. There's just a number of things happening. There's a little bit of erratic earnings going on out there. There are companies spending more on artificial intelligence than they thought, getting less return than they expected, and just a number of things. But you can see that here in this 6-month look, that number on the far right has actually ramped up to a fairly uncomfortable level here over the last few days. And the Investopedia definition is right there. And that's just kind of the current situation. Now, how does it compare to what's happened historically? That's what you see here. And this is why the rhinos and institutional investors have the heebie-jeebies right now. Because here you're looking at the VIX going back 25 years. And you can see the financial crisis and the pandemic. And we've actually managed to get to a level of volatility not seen since the pandemic, and then going all the way back to the financial crisis. So that's why we're spending so much time talking about it on TV. So I think that puts it into a little perspective. Anything you would share here, Ken?
Well, I have my own explanation for what I think might be going on. I think an awful lot of retail investors got themselves into the Magnificent Seven or the top three or whatever you want to call the 8 or 10 stocks that are kind of making up this market, and we know the names as well as anybody else. You know, starting with Nvidia and Google and Microsoft and some of those companies. And I think that once the selling began, I think that for the first time in a long time, the prospect of losing all of your profit, just having it whisper away, became more stark than paying the taxes on the capital gain. And I think a lot of retail investors headed for the hills on some of these big stocks and drove them down to a place where they've become much more reasonably valued at this point now. I think I shared with you earlier today or yesterday that I feel that there's kind of a natural floor for Nvidia, for example, right now at about $100. I've been watching it, and it seems that every time it gets down to 100, it bounces back up again. And I think maybe that's the psychological place. I don't believe in the magic of technical analysis, but I do believe in the psychology of the normal investor. And I think that might be the place where people feel that it's a bargain, somewhere around that nice round number of 100. And so they rush back into the stock. But I think that they got more scared of losing the profit than they did of the tax man. And so they sold.
Yeah, it's something that you can sink your teeth into, and whether or not you agree, you can understand that type of behavior. So I think we'll cover that a little bit more when we get into the Cramer moments here in a little bit. So,
yeah, our friend Kevin, who's having technical problems, also says that this might have been a case of a whole lot of stop loss orders suddenly being triggered as the market fell right through those stop losses.
Oh, I think that's a given. In fact, we've talked about doing a dedicated segment to stop loss orders and the proper use of them and the risks that you're taking. And I know people in the business that harvest them, so I mean the risks are real, and they'll drive prices down just to do that. So, okay, this one's really busy. I apologize for that, but this is we used to love to put the value line chart up that showed multiple decades. This one goes back 100 years and just simply goes one more step in presenting that magic number on the far right, Ken's 10%. And I'll go ahead and grab my pen here. If I can get control of my computer. The 10% number is right there. I know it's little. It's also mentioned right down here, and then the all-time number. I'm going to just go over the risk. So again, for 100 years, the return on U.S. stocks in general, the general average U.S. stock has been 10%. And then all of those other investment vehicles are listed along the way also. So you can see some of them are less bumpy, and there's a reason that income portfolios can be important for people with the right characteristics in terms of time horizon and capital preservation. It flattens out a bit, but this is my favorite thing to talk about, and we've done it many times, Ken. We spend an awful lot of time worrying about recessions and bear markets, and here you're looking at 100 years of bull markets signified by the stuff above the line, these blue areas. We've been in a long bull market for a while here since the end of the lost decade, which is right here. And again, this stuff back here was really the OK corral, so we kind of ignore that. In fact, anytime that I think about the market, I basically leave everything before 1940 off. But look at the number of the amount of area, the amount of blue surface area compared to these little red, I almost want to call them udders. I can't do that. But we spend an awful lot of time worrying about recessions and corrections, and it just seems like wasted worry to me. Your thoughts, sir?
Well, I'm going to call them icicles, Mark. All right. And, if this were were the good old days. And if I were using a money manager, which I probably would have been using 50 years ago, instead of trying to run my own portfolios as I do, I probably would be in somewhere around 75% bonds today, and my returns would probably be less than half of what my returns actually are in the portfolios that I'm running today. So philosophies have changed, things have changed. These numbers are not inflation adjusted, so you might want to take a look at some of the charts we've put up in the last couple of weeks where we show these kind of graphs that are inflation adjusted. But that average return of 10% for a nice, U.S. stock average, and since none of the indexes except, I don't know, has the Dow been around for 100 years now, Mark? I know it's not the same companies, but has the Dow been around that long?
Oh, the answer is yes, but I'm not sure how much more it predates it by. We need Ted for that one.
I don't exactly know what they're using to measure U.S. stocks. It's probably a combination of different indexes as you go through history, but that 10 number has stayed pretty good for us to take a look at over a long period of time, and it's a good source for us to match everything else to. And that's all we use it for anyway. We don't use it for anything other than something to match to when we're kind of trying to figure out how our own investments are doing.
Yep. One other thing I wanted to use this slide to basically remind and represent is when George Nicholson designed the stock selection guide back in the 1930s and refined it in the 1940s, early 1950s. One of the reasons that he had a 10-year historical period was he wanted to include 2 recessions in the look at the historical results from the company. And if you look at these gray shaded areas, sure enough, back in that time frame, you basically had approximately 2 recessions, within each 10-year period. As you can see, that's all changed. I mean, here's one recession here. Here's another one here. I don't really count the COVID recession as a real recession, but it's there. So you do not, for the last 20 or almost 30 years, we have not had that with our studies that include 10 years of historical data. And this just shows it pretty graphically. So just a quick reminder that is a situation.
If we had one wish list, and it probably would be for a standard stock selection guide to maybe start including 15 or even 20 years of history backing us up, because with a 10-year time frame, a lot of times companies are able to masquerade as a growth company that aren't really as growthy as you might like to see them when you kind of expand the graph and look at what they've done during recessions. They become a little bit more cyclical at that point then.
Yeah, and we actually penalize companies that don't have sufficient history such that they have survived and shown how well they would do, during a recession. So, I mean, if you're looking at a company right now with 8 or 9 years of history, you really do not have a look at how that company performed during a period of great challenge.
Well, and especially since the last recession was completely foreign to any history that we've had for any length of time. The COVID impact on the stock market, the closing down of the American, in fact, the worldwide economy for a long period of time is unprecedented. That didn't happen in the 20s with the Spanish flu epidemic. It didn't happen then, but it did happen now, and we tend to discount it when we look at the history now. Even when we're listening to stock presentations, we hear people say, well, and what happened here, and then they just move on,
Yeah, and frankly, there are many companies where you want to leave that year out of the analysis because it was so unusual. Yep. All right, so here's our weekly look at the market as measured by the value line arithmetic average. That's the green bars that you see. Those are quarterly numbers. You can see that the forecasts as given by value line have actually dipped down to 8.8%. And the yellow ones are the historical time series for that. And the two run pretty much together. and they have basically bumped back up a little bit with the last few days. You'll probably see the value line number go back up as a result of the drop in the market. The drop in the market has been pretty large. I noticed that we'd actually dropped below 10,000 as of tonight on the value line arithmetic average. We had been above 10,000 for almost a year. So again, we'll talk about these in a minute. These were moments of opportunity during COVID and the financial crisis. Quick look at the performance of our 10 most widely followed stocks, the 10 stocks that you see listed there compared to the indices and the round table. Those numbers are all lower, and this one kind of surprised me, Ken. With Warren selling a bunch of Apple, Cognizant has taken over first place on this chart over the last few decades.
And if you've owned it for that long, and I'm not ashamed to say I do, and I still do in my personal portfolios, if you've owned it for that long, it's certainly been a great stock to hold. It's just in its recent returns, we've been having some issues with it. That's all.
And we just generally like to point out that, wow, those top 7 stocks are in many of our portfolios. It's not science fiction to believe that our community can pick those types of companies over time. One of our largest family holdings is Stryker, and that's actually been quite kind to us even through some challenging periods. Nothing wrong with any of those returns at the top of the chart. All right. So let's switch gears and talk a little bit about one of our buddies, Jim Cramer. Jim Cramer gets a lot of negative press on Reddit. They just rip him up on a nightly basis. There are actually funds that are formed to do the opposite of the things that he recommends. It's just really brutal. That graphic on the right was actually some fun that we had back, believe it or not, Ken, back in 2009 when Cramer appeared on the Daily Show with Jon Stewart, and that was a rough segment. And but we actually did a program in March 2015 on that book, and I was quite surprised. In fact, I've got a copy of it sitting right here. Went back and took a look through some of the pages. It was a book where we did a stock up with the NAIC Better Investing audience back in March 2015, and the consensus from all of us that participated that night were that we were kind of surprised, pleasantly surprised by the tone and character of the book. What were your thoughts, Ken? What do you remember?
Well, I think we concluded, Mark, by saying that we think that Jim Cramer might actually be a fundamental investor. In fact, we were pretty sure that he was a fundamental investor, and he was singing the same songs, maybe different arrangements of those songs, but he was still singing all the same songs that we were singing. I'll admit a little bit of disappointment in putting a $200 and some odd price tag on joining his investors club on CNBC, because I'm not sure that the average person gets $200 plus out of that program. Maybe if they listen carefully and follow all 25 of his rules, they do. But when you read Cramer's rules, I really think that you can have no problems in agreeing with 21, 22 of those rules. There's a couple of them that I kind of go, what? But for the most part, I think that's a great list of rules, and you could do a lot worse than to follow his set of rules as an investor.
And we're going to take a look at those 25, so let's go ahead and keep marching on. I also wanted to point out, because, I don't think he gets enough good press when he deserves it. And back during the pandemic, he put out his basically a model portfolio of companies that he thought would be well positioned during the pandemic. And some of these prices might be off a little bit. They're not adjusted for dividends or splits. But I would like the audience just to kind of walk down that list. And I found it fascinating. Look at Eli Lilly up at the top of that list, by the way, which maybe was obvious at the time, but I'm not so sure that it was, but the fact that he's got those food companies, he's got Costco in there, Microsoft. It's a pretty good list of companies, and it has done quite well. And we marvel.
Well, he's picking AMD, Mark, when nobody's picking AMD.
Mm-hmm.
You know.
And how about Wingstop? That was one of our best small companies during that.
Absolutely, absolutely.
And I resisted it all the way to, I'm not ashamed to admit it. It was a good call, good results. So good list of companies, good theme, good approach, and let's give credit where credit is due. All right, so with that, I thought we would just go through. This is something that one of Ken's investment clubs kind of did as an exercise. Take a look at his 25 rules for investing. You guys have probably all heard that first one, so we're not going to spend any time on it. Yeah, you can just put your head down, be patient and disciplined, and there's an opportunity to do pretty well. And like Ken said, we're going to agree with most of these.
Yeah, I think that rule number 2, Mark, is one of the most difficult things for a large club that's been in operation for a long time to deal with. And it's this idea that it's okay to pay the taxes, that paying those capital gains taxes means you're making money. And, I've watched clubs get into just knockdown dragouts about holding things that they know they shouldn't be holding anymore because they don't want to pay the capital gains tax on the sale. But first of all, I would suggest that if your club is having a problem with this, that you take a couple of meetings to actually get somebody to present how much capital gains taxes are and how they're calculated. Because the standard answer I get when I visit an investment club is that you pay capital gains on the first dollar, and you pay it at the same rate that you're paying your income tax, and neither of those statements is true.
Mm-hmm.
So do some research, find out about them. Don't just be afraid of them. Find out about them, and then find out exactly what those capital gains taxes would be to some of your members. Remember, folks, that you've already paid tax on any dividends that you have in a club account, and you've already paid tax on any of your capital contributions that you've made to your club account. So that part of your club account isn't part of your capital gains. That's your basis, if you will. And you don't pay tax on that if you withdraw the whole lump sum all at once. That's tax-free. But you do pay capital gains on the rest, and you need to find out how much and when.
Yeah, I think this one's extremely important, and this is a very personal example. I mean, I was in an investment club that had 50 or 60,000 shares of Qualcomm back in this time frame, and this was Christmas week, 1999. Our office was closed. We were actually at home, and we watched the stock price nearly double over a period of a few days. And that particular investment club that I was in had that argument that Ken is talking about. When they got together and they wanted to talk about trimming that position, they were reluctant to because of the capital gains. And over the next month, and then kind of settled out after that, the capital gains challenge went down a little bit. And I'm really
took care of themselves, didn't it?
I'm really, again, I had 0.1% of this club, so I couldn't say much, but I did actually attempt to persuade them to understand what they were pushing back against, because in fact, this is after or before after a 10-to-1 split. The stock price literally went from 400 to 1,000 in a few days. And it was really, Ken Janke said it was the wildest thing he'd ever seen in a lifetime of investing. So it's real. Don't let the taxes interfere. Make sure you understand, and don't be afraid to celebrate victory when the time is right. We'll cover that in a little more detail shortly. This rule number 3, I'm not sure I'm on board with this one, Ken. I mean, I quite often will invest 5% of total assets in basically a 20 stock portfolio without hesitation. I don't like to dribble in, 0.5, 1, or 2% at a time. That I think it's personal choice, but for me,
I make a distinction, Mark. As an individual, you can decide when you're going to make that buy over a 30, any month over a 30-day period or a 20-day trading period. But in a club, you can only make that decision once a month.
yeah,
And sometimes I think that I think this is the old dollar cost averaging number 3, just in different words.
okay,
And sometimes I do think it makes sense for a club to divide what they want to put into a full position, divide it into 2 or 3 pieces and put it in 2 or 3 times rather than just once. And then the other side of the coin is most of the time a club doesn't have enough to make a full position in the first place. And I think that's what he's talking about is full positions,
okay.
not about how much money you have.
All right, I can buy that, and it applies to selling also. And then here's kind of our general guidelines for the ranges in terms of percent of total assets, and those can bend a little bit also. Can be a reason for selling, or perhaps trimming something out of the portfolio if it's below that lower threshold. Rule number 4, yeah, I think we really agree with this, especially if we clarify that a damaged stock, what he really means by that is a company where the fundamentals are all okay and the return forecast, the PAR, is elevated. That's what he's talking about here. A quality company with an elevated PAR. So I think we can agree with that wholeheartedly. But damaged stocks could mean something different to other people, though. In fact, I've been at club meetings where they were attempting to buy turnaround situations that were quote unquote damaged. That's a little bit tougher challenge. All right, diversify to control risk. I disagree with that. I think we diversify to optimize our probability of successful returns. And we center our diversification around the growth aspects of the individual holdings. And I think it's something that we do that's a little bit different. I do agree that diversification is a good thing in general. I think obsessing over sector diversification as one example is not the best idea or use of time. But
well, and I think sector diversification and industry diversification is the first thing that comes to mind with a lot of retail investors. Our emphasis on looking for different sizes of companies based on how fast they grow is a kind of diversification that's not immediately obvious to a lot of people. And yet it's the kind of investing that will take a portfolio and move it towards the goals that we've set, which is beating the market. If you're constantly looking at slow growing blue chips that are going to grow at 6, 7, 8%, you might be able to diversify within those kind of companies, but you aren't going to have performance that is market beating.
Absolutely. All right, so that's just a little bit of a tidbit of disagreement. This one, absolutely. I think they'll do your stock homework, try to do your best to understand your investment, understand what you're investing in and the role that it plays. So I'm going to give 6 an absolute check.
I agree with number 7, Mark, right straight out. You don't make anything by panicking. You don't make any good decisions in a panic mode, whether it's buying, selling, or holding. Any of those things, you have to be calm. You have to have some discipline, and you have to be patient. Those are those 3 words that keep coming up all of the time when we're talking about good, solid, fundamental investing.
Yeah, absolutely. Again, don't obsess over Ken's icicles. And if the clarions are flashing on CNBC, don't panic. Put your head down and go find something to invest in. I mean, these are 2 of the magical points in recent history, both during the COVID situation of a couple of years ago and even more so back in 2008, 2009, an absolute back up the truck moment at the end of 2008 and into March 2009. Some of the best investments in our portfolios came at that time. And that's what, don't panic, go and shop prudently comes into play. The one time when I would panic would be if the stock prices were dropping as shown here, and these return forecasts were also dropping because we're into a whole different ballgame. We've never seen that. If we ever do, I'm going to head for an island or South America. Yeah.
You're probably too late at that point, Mark. Okay.
Go find some real inflation. So anyhow, those are moments of opportunity, those peaks on those right-hand graphs. So don't panic. Just do it. All right. Well, Ken, best of breed companies.
Well, buy the best. That's a direct quote from George Nicholson. That's why my clubs do industry studies. That's why we say never study a stock in isolation. Always look at one or two competitors. You might be. I'm continually surprised when I find a really good stock, and then I do a little bit of digging and find an even better stock that I didn't even know about or that I forgot about. One of the two. So that kind of discipline helps boost your portfolio's return. And when when the rubber hits the road, not every stock in your portfolio can be defended. If you've had a thesis about a turnaround company and you got to do some selling, maybe that turnaround gets thrown under the bus and you kind of defend your high quality core companies and not some of the special situations that are in your portfolio. I hope your portfolio is not full of all non-core, but sometimes you throw a non-core under the bus before you throw a core.
Yeah, and as I read the narrative that he put together for this one, it just reminded me of how you will classify or characterize core versus non-core. This is actually from one of your stock up presentations, and obviously up straight and parallel is the lion's share, the 70, 80, or in some cases 90% of our portfolios, and you defend those until when they need it as part of a portfolio-centered approach to investing.
Well, and Mark, I think we've shown after some of these huge drops in the market that we've been pointing out, this after COVID, after the financial crisis, after the dot-com bubble, I think we've shown that your core stocks tend to recover more quickly and in a more defined manner. There's not so much chance involved with the fact that they probably will recover versus a non-core that a lot of times never recovers from one of these situations. We're still looking at stocks from the pandemic that were darlings for a couple of months and then crashed and have never really fully recovered at all. We won't mention any names, but you know some of them that are out there.
Absolutely. Rule number 10, that's just a quick look at a personal experience. I've given one of the best stock studies in the history of investing on Iconics brands. And in fact, that was the birth of our rule of 5 selling principle on if it goes down a bunch, maybe you want to reassess it and don't be stubborn about it. And you can see that our $1,000 from the round table ultimately became 34. So if it's a bad buy, call timeout and do the right thing. I think number 11 is easy. If you have too many stocks, you'll become an index. And that was easy to agree with.
And then to quote a wise man, sometimes you start forgetting about some of them too.
Mm-hmm. Cash is for winners. I wish I had more cash this morning. But yeah, I don't generally follow this notion of building up a huge reserve to go shopping when bad things happen, but basically invest regularly and buy and hold for as long as it makes sense to do so, and let the cash be kind of a natural flow from prudent selling and replacing. And then I'm not sure, other than I live this every day, so we'll just go on from there. Again, expect days like today to happen. They don't happen a lot, but they happen. Don't be surprised. Don't fear corrections.
That is really important, Mark, right? So if you're in the market for a long time, both just overall as a investment experience, but a long-term focus, it's just something that will come up on the calendar. I think surprise is a big part of why retail brokers crashed, right? Everybody went on there and it was all in the morning, and some of it was back by the afternoon. It's the herd going into a run, and it's really, you can imagine a bunch of people thinking about it, but it certainly was not an unprecedented day in the history of the market. So what's the big deal?
Yep.
We have Patricia out there, Mark, asking how many stocks is too many? And Patricia, I don't think there's an answer to that, except that I think that somebody needs to say to anybody asking that question, how much time do you have? How much effort do you want to really put in? How much homework do you really want to do? Because that will probably generate a great answer as to how many stocks you should own. I think some people can own 30 or 40 stocks. And if they're very prudent in choosing those stocks, and if they do their homework, they might be able to watch that many. But I think for most of us, when it starts getting up into the high teens and the low 20s, we've about exhausted the amount of time and patience we have with the stock market, and we want to do other things with our life besides just sit and babysit those stocks. So I like to use the number 16 plus or minus 4. And that's where the clubs that I belong to tend to stay in that particular range with numbers of stocks in the portfolio as well.
Yeah, from a diversification standpoint, 12 is kind of a minimum that's cited by many. I will share that I think I've done better in the 10 to 20 range over the last several decades. I have had periods when I got up into the 30 to 40 range, and that wasn't helpful. Performance suffered a little bit. I think the 12 to 20 is a better idea, and somewhere in that range makes sense for just about everybody. By the way, Buffett only had about a dozen stocks 20 years ago, even though he had billions of dollars invested. So it's not a.
Charlie Munger says 5, but that's singular. Don't recommend that level.
Kim, what do you think?
I think if you get like over 20 and 30 and up to 40, I think that's called diversification.
Yeah, that's a good word for it. I totally agree with what you said, Ken. That's the number one reason why. Yep. If you're going to be good at this, you have to put in the time. There's no miracle. There's no formula or tool. You got to have the time and make sure you're following it. But I think in terms of maybe how to picture it mentally, there's also the point we talked about, what is a full size in your portfolio? If you have 30 stocks and a full size is 3%, and if that doubles, so what? Right. As opposed to 10% or even 5% is a much bigger thing. And then the other way to look at it is how invested are you in your 30th best idea? You don't really have that many good ideas in a lifetime, much less all at once. So
that's a really good way to phrase it, Mark. Your 30th best idea. That's a real good way to phrase it. Okay.
Yeah. All right, let's keep forging ahead. We don't want to run too long here tonight, although this is kind of fun. I kind of disagree with this one. You can. It's all a personal choice. The books by John Bogle are great on this subject, and I would encourage people to look at them. Kind of falls into the asset allocation realm. I'll just share the personal story that Tom O'Hara, who was with the National Association of Investors for more than 50 years, told me that he had one bond in his lifetime. And trust me, I saw the numbers. I saw all of his portfolios. The man was not suffering, and he had one bond. Wasn't even sure he could find it in his lifetime. So yeah, if you reach that stage where you have capital to preserve and protect, that's a personal decision, but I'm just going to dissent a little bit with Mr. Cramer on that one.
Well, I think a couple of things, Mark. First of all, I think this is Cramer's early experience with the stock market coming out in a rule, because he started out doing a lot of work with bonds and bond trading. Yes. In his early years. So I think that's part of just his personal history. I don't have 50 years in the market like Mr. O'Hara did, but I have about 38 years in the market. And over those 38 years, I've owned one bond. It's a bond fund. And it was there because in my second year of investing, Louis Rukeyser recommended it. And so I bought it. I was really into reading newsletters and buying whatever they said early on in my investing career. And Louis Rukeyser said, buy MFBFX. It's a municipal bond fund. And I still own it today. And the reason I own it today is to remind myself what a really lousy return I get on it when you compare it to everything else in the portfolio.
Oh, man.
So, you know, it's an object lesson, and it feels valuable to keep that right in full view of myself when I start thinking about these people that are telling me to buy lots of bonds. And I kind of stay away from that.
All right, number 16, I'm just going to really rapidly paraphrase. I really think what he's talking about there is selling the winners and then kind of doubling down on the positions that have dropped, so-called losers. And we simply believe that you should sell things to make the portfolio better, improve the quality, improve the return forecast. That's how we would interpret number 16. So I think we basically agree. It's just a matter of terminology, maybe a tiny bit of philosophy. All right, so
maybe also he's talking about this idea of holding something till it gets back to where you bought it and then trying to sell it, you know?
Well, yeah, that's number 17. I think these two go together.
Oh, okay, there it is, right there. Okay.
Yeah, and yeah, my skin crawls when I recognize that I'm doing this. Yeah, I'll sell it when it gets back to what I bought it for. It's kind of a way of avoiding that you may.
I was going to say that flies in the face of for a while, Jim's real catchphrase was getting back to even in a book by the same title.
I think we pointed that out during a bull session. Good stuff. All right, number 18, be flexible. I think that's a good idea, but I think he's also kind of opening the door to style drift when it comes to investing with this rule, and that can be dangerous, extremely dangerous. I think I'll try sector rotation for the next couple of years and see how that works out. That's what I interpreted.
I do think that flexibility talks about the fact that there are great companies that are no longer great anymore. And you have to be flexible enough to realize that you maybe can't hold every one of your companies for 30 years. You know, you have to sometimes sell companies, even though they're like stepchildren to you. Sometimes companies decline in their older age. We won't get political at all. Keep going.
Okay. Number 19, when the Chiefs retreat, so should you. Kim is probably the best at this amongst all of us. I will point out that Phil Keating, again, one of the legends of better investing, he used to keep 2 index cards in his wallet. Companies that he would buy if the company plane went down, and companies that he would sell if the company plane went down. So basically, if the corner office is empty all of a sudden, you need to be careful about that. And Kim pays pretty close attention to the executive suite, what they're up to. So, do you agree with this one, Kim?
Yeah, absolutely. If I like seeing what the CEO and the CFO are doing. Are they buying back shares? I'm not really worried about if they're selling shares. They got kids, wives, things they got to pay for. But when they're buying, I get really interested. And when all of a sudden you have a CFO that leaves and has been going along real well, and then you've got a business that's struggling and they leave, it's like, what else do they know?
Absolutely. I mean, I can remember we picked the company for the Better Investing cover stock years ago. We came back from lunch to discover that the CFO was in Mexico sipping umbrella drinks. And he left the country, so we had to change our mind. So
that wasn't a Houston-based company, was it, Mark?
No, I think it was actually Elkhart, Indiana.
Oh, okay. I was thinking of a Houston-based company that you picked one time in Better Investing magazine and came back to find out it had cratered.
Well, that was Enron, and that was a different situation. We could spend a lot of time talking about that one. All right, let's go ahead and try to wrap up. Number 20, giving up on value is a sin. Well, first of all, we don't do value. We do all of the above investing. But yeah, I think in reading his background commentary on it, he's really talking about patience and watching and monitoring the most important influences on your company. So yeah, I agree with that one completely. Any other comments on that?
No, none at all.
All right, you are the TV expert, Ken. Are
Well,
you ever suspect of what you see presented to you on a...
oh, no, I just take it all fully and believe every bit of it, Mark. Even when within the next half an hour, they tell me something completely different. These books by Hans Rosling, and this is the first one in a series of a couple of books, this Factfulness. If you haven't read anything by Rosling, pick this book up and read it. It's amazing. Some of the things that we think are true, or we have a sense of being true. We call it common sense, and it's not common and it's not sensical at all. So be a critic of almost anybody that's on TV on a regular basis, and be a critic of Mark and myself as well. We don't have all of the answers, and if we did, I'm wondering if we would be doing both sessions. Mark, what do you think?
I'd be sipping that umbrella drink with the CFO. The other thing I wanted to point out with the Red Rabbit, again, if you are focusing on the small and medium-sized companies, those are not the ones on CNBC, at least not very often, and that actually will insulate you from some of the large company noise that you might encounter. And then this is one of our favorite sessions of all time. Jim Bowen is CEO over at First Trust in the Chicago area, and he did make some political commentary that didn't age particularly well in this particular presentation, but he talked about be careful about narratives, and math wins. And I like both of those sentiments. This one, I'm not sure I get it all. I just probably haven't paid enough attention to it. Cramer talked about waiting 30 days anytime there's a disruption. First of all, I don't think he follows that advice, but if there's a disruption, put it in the drawer.
Mark, I have my own rule that when a stock craters, and sometimes it craters before you have any reason to believe it's going to, and before you have any knowledge that it's happening. But when it craters, I never want to sell it immediately. My own personal rule is to wait 2 or 3 weeks. Usually it doesn't have much further to go on the downward drift, and a lot of times it does a remarkable partial recovery, and then if you still want to sell it, you haven't lost nearly as much as maybe you would have if you followed the recommendation and sold at the low.
Yeah, I could see that. I mean, I do scratch my head a little bit more over that one.
Okay.
All right, so the last 3 picks, beware the Wall Street hype. That kind of goes with the previous comment about making sure that you understand the facts. The other thing that I would point out, and this is eminently true, there's a difference between investing and trading. Different narratives. You can have 2 things. Intel could be a terrible stock for the next week, but a great stock for the next 5 years. So there is a difference, and Wall Street concentrates on one of those 2 things. And it's up to you to decide what they're concentrating on most of the time. All right, explaining your picks, our roundtable, I think we do a pretty decent job of laying out the companies. The crayons are in homage to Peter Lynch's. You ought to be able to, in 3 to 5 minutes, with a set of crayons, explain the investment merits of any company. I mean, we believe that. And I just listed the stuff on the right that you should be able to defend. Present and defend.
I like that word better, Mark, than explain even, and that's to defend your picks. You should be able to defend them. Yeah.
You know, an investment club debate discussion is intended to be a learning opportunity. You're not going to be right all the time, but that's what it should be. And then last but not least, his tagline. There's always a bull market, and we really believe that, going back to that graph we talked about just a few minutes ago, until there's a point when the return forecasts are going down at the same time that the prices are going down. There's a bull market somewhere. I will try to find it for you. And I think, as Ken said earlier, I think he's more like us than people realize. And some of the stuff he probably does quietly is when he's not throwing furniture is probably a pretty good deal. All right, so that's the 25. I agree with you, Ken. I think we rhyme with many of them. Just a couple of minor exceptions. So good, clean fun. So with that, now we are a little bit long. Ken, what are your thoughts? Should we give Matt a few minutes to do the special nighttime, or should we save this section? I'll leave it up to you. Also, Matt,
I think this is a wonderful presentation that Matt's put together, and I'm wondering if we can just drop it right into next Tuesday's bull session, Mark.
What are your thoughts, Matt?
I think that's fine. I mean, I was inspired just because yesterday was down, but it's not down a second day, so it's emergency's over, I guess.
Until tomorrow, right, Matt? Until tomorrow, okay?
Yeah. Until Japan's open.
What I'm thinking is let's do a quick tease.
All right, that sounds good.
And I'd like to do this one, and then I'd also like to finish with the last one because I think it's such a powerful, consistent theme, and then we could do the whole.
Maybe to give a background. So I get my talk at Bink was coping with the psychology of investing. A lot of that material we went through in discussion form in this forum now a couple of years ago, talking about history. And I loved it, and it was a great class. But I came away with it with some ideas for improvement. One of the things was kind of modularizing the material so we could, at the option of the audience, go more in depth. Mm-hmm. So this series is a snippet of what I'm calling keeping scores. The idea of how do you know how you're performing against the market, and quite explicitly, how often do you check, right? What do you check against, and how are you checking? This is kind of a snippet, but the idea is that 55%. It's now in the roundtable slide regularly. I've gone through the citations. And again, it's not just in investing. We're going to do the whole thing here, Mark. It also was, it really was my inspiration was hearing Annie Duke talk about it in terms of poker play, in terms of 60% being the outer bands. She talks about it in a negative standpoint. You're going to lose 40% of the time, and that's a world-class player. But, call that 60%, and with Mark's fat PowerPoint markup marker, that's about the same. And then, of course, going on in a more recent one, which was I just had to laugh out loud to see, even in tennis, where we have good statistics on that, right? So you can win, in Rogers' terms, 58% of your games. That becomes 80% of your matches and becomes one of the all-time greats, right? So this is not grading in terms of grade school, where an A is 90% or above. This gets to be a point where a small advantage repeated over and over again becomes just overwhelming. And part of my summer reading, we talk about books that we read long ago, was to go back to, I'll say, I did Andre Agassi because at first I thought Andre Agassi is who we're talking about. And it turns out Andre Agassi has very similar numbers. Not quite as good as Roger. Go ahead and discuss, tennis fans. But again, games won in the 50s, matches won in the 76, one of the all-time greats for sure.
I wonder how Carlos stacks up on that one. Let's go ahead.
Yeah. So it was Fooled by Randomness by Nassim Taleb. And he's a very interesting guy. He's very skeptical of let's say, economists acting as scientists or thinking there's a lot of math behind things versus observation, because we don't have a control version of the U.S. economy to experiment on. But he does use math for understanding, to explain concepts. And he actually went through, I say, if you're going to skip fast. I don't want to spoil the whole thing. He has a statistical explanation of 55%.
Oh, cool.
Yeah, that's the thing, and he uses it. You could call Fooled by Randomness fun with the Monte Carlo generator. That's about half of it. But really, I was primed. We talk about being primed. I was very primed about these numbers. I'd come away when I first read the book, and it came out in 2005. I read it probably before 2010. Yeah, don't show all that. No, I'm going to want to talk about it.
I know we're going to cover this in the future.
All right.
Because I think it's.
I was very I came away with the book as finding it very interesting, but not taking a lot of specifics away from it. And I'm highlighting the heck out of this because it really correlates and gets to the level of proof of a lot of things that we've seen in a lot of my reading to now. So a lot of it comes back to Fooled by Randomness, so we'll talk about more Tuesday.
Okay. Yeah, this is and this is what Matt was referring to, the 55% being in our updates every month at the Mid-Michigan Roundtables. And just as an aside, all of the nights of the roundtable are in the, I would say, 52 to 60% when it comes to that number. And led by Ann Manning, by the way. She's the one that she has the highest percentage when it comes down to her frequency of outperforming the market. So good stuff. And then I think this last one, especially with today's, well, over the last 3 days, the market performance, it's one of our favorite slides. And Matt, how does it strike you?
Yeah, well, this is, I preface these two slides by talking about skewness, right? If, you know, and I actually want to go and find a casino game to add to my list of things that follow this rule. But if you think about, you know, casinos never put out a game that doesn't have an edge, a point where what looks like a 50-50 bet is slightly in their favor. You know, in roulette, you have the 0 and 0-0 numbers, which don't pay off on black or red. That's how they make their money. And they just count on playing enough rounds that will come into a factor. In this sense, we also have a natural advantage because there's a point, and of course we don't encourage leverage. If you're not levered, the most you can lose is 100%. And as we've talked a lot about today, you know, that doesn't happen all at once. You know, unless you're using options, and suddenly it happens to you. You know, you might have down days, you have decisions, but you usually have a very long time to avoid 100% outage or 100% loss. But you know, the gain is effectively infinite. It certainly can be in the thousands or tens of thousands of percent in those once in a lifetime buys or once in a generation buys. And so this was a great, this is actually bookends this section. It ends abruptly because this is just a snippet of the presentation, but I bookend this section to say, you know, this was a 5-time pick, but it was over a number of years, but this gain really should take away all fear. Was the Roger Federer of the roundtable portfolio.
Yeah, I mean, every time I see this, it just screams at me, what would we ever be afraid of if all of those losses, 220 losses out of, 780 decisions, some of them locked in, but I mean, that one single holding, offsetting all of those losses is just phenomenal, and that's how you get to the 16%.
Matt, I never thought of the 55% as pertaining to my job when I was a professional educator, but I'm thinking back to my mentor, who was the chairman of the math department at the college where I went, my personal advisor and my friend and confidant. And he left me some information about testing. And he said a good test should be designed so that the best person in the class only does 55 to 65% correct, because then the teacher will know what hasn't been taught and the student will know that they're not perfect. You know, and that throws out obviously the old 90 to 100, 80 to 90, 70, you know, that kind of thing.
Yeah.
But it certainly comes into line with this idea of knowing 55 or 60% of the material to start with, and having something to push at. I like what you're doing here. I really, really do, and I want to hear the whole thing.
Great.
Good stuff. Looking forward to it, and the roundtable's doing just fine, even with all the challenges of the market over the last few days. So with that, we will defer, and I'm going to sneak in and read that book, Matt, to be prepared for you. So
okay, it is not a fast read. Or let me say, if you read it really fast, you're doing it wrong. That's probably why I did it wrong. You read, it's not Life After Google, but it's a good one to read a chapter or two and walk away and ponder on for a while.
Would you advise having a margarita while you read it, or?
It could help if you don't have your own personal Monte Carlo generator for fun, it might help.
Oh, okay, good stuff.
But the example is chapter 3, so you also don't have to finish the book to get to that point anyway.
All right, I will keep that in mind. All right, this is for the audience, just to remind you that we do on the YouTube, on youtube.com, if you go and search for Manifest Investing, in either roundtable and bull sessions, you'll find that we have archived many years of all of these sessions. The roundtable goes back almost the full 14 years, and all of the bull sessions, I believe, are here. If you do hit that subscribe button, we are not going to get wealthy. Every once in a while, YouTube will offer to buy us a cup of coffee, maybe, but it's actually more for you. We will notify you whenever new content is added to the channel. We did just recently celebrate our 14th birthday at the roundtable, and that is cake. And with that, we like to have a timely photo or two. There's a number of them coming out of Paris. Who didn't enjoy the ladies gymnasts? I mean, that was a pretty spectacular run. The surfing in Tahiti was pretty cool. Great picture. Probably one of the award-winning photos of the year down there on the lower left. And what a 100-meter dash on the upper right. I mean, it came down to 5 thousandths of a second.
My favorite article on that was, if that was swimming, it would have been a tie.
Really?
Yeah, I didn't get into the esoteric parts of it, but basically that difference wouldn't have counted in swimming.
Well, I learned that it's basically the base of their neck or their Adam's apple that gets counted, the top of their torso. So I didn't know that until watching that event. The other thing that's kind of interesting is the 7th place finisher would have medaled in Tokyo 4 years ago, and the 8th place finisher in that race would have won the gold medal versus Carl Lewis 16 years ago. I mean, that just shows you the progress over time. So good clean fun there for sure.
Mark, I don't want to panic Steve in the audience, but are we presenting on Thursday to Arizona?
We are.
We are.
Yeah.
Okay.
I'll talk about that tomorrow with you.
Okay. Okay.
Snuck up on you, huh?
Very much so. I'll be on the phone with you right after we're off here. Okay.
Okay. Well, I am for sure. If you can't make it, they understand. All right. Anything else in the hopper or things that we need to do? Thanks, Matt. We look forward to that. Should be some good fun with math.
Mm-hmm.
Anything else, sir?
No, this has been a good one, and we have next Tuesday pretty well set. And let's lead with Matt next Tuesday, okay?
Sounds good to me. All right. Thanks, Matt.
Either that or we could play Jimmy Kimmel, and he can be like one of the guests that never makes it on. I don't know.
Now, come on.
No.
That would be Portillo's, actually. Or
We're not gonna call you Matt Damon, okay? All right.
Isn't that Kevin's role, really? At least today?
Could be. He's without Mike, so he can't defend himself, all right?
Oh, it's so refreshing. All right. Well, thanks, Matt. Thanks, Kim. Ken, continue to enjoy your relaxation. And everybody
I will.
out there, and if anybody out there finds an absolute can't miss opportunity, let us know about it on the Manifest Forum. So with that, thanks everybody, and good evening.
Good night, everybody. Have a good one.